So, welcome everyone. I'm Suruchi Jain, Managing Director and Founder of Opportune Wealth Advisors Private Limited. We'll be covering essentially investing in equities. That's the broad theme of the presentation today. Sorry, I don't know what it is now. So, throughout the presentation, you'll see a lot of Warren Buffett quotes. And the reason for that, other than him, of course, being one of the most famous investors, is that the reason I got into equities was after I met him in 2011, pretty much Feb of 2011, 3 months before I was graduating from business school. I happened to meet him in Omaha through a MBA trip there. And it basically changed the course of what I was going to do later. So what Buffett says is, if you don't find a way to make money while you sleep, then you will work until you die. He has a way of putting things in a little bit of a sordid manner, but so our mission is essentially to help clients gain equity exposure in their portfolio with the objective of long-term appreciation of their wealth. 2 quick points: we were incorporated on 3rd May 2016, and we started investing on 2nd September 2016. Our products, so we offer direct equity portfolios, which are essentially concentrated portfolios. Currently, we have 14 stocks in our portfolio. It's mostly multi-cap, large, mid, and small cap, and it's model portfolio driven. This is just a rough look at what our current portfolio allocation is. So you can see banks is 17%. So it's a good mix. Financial services 30%. So consumer is 14%. So it's a good overall mix of a couple of sectors. The second thing we offer is mutual fund investing. So we offer all and any mutual funds that you would be interested in, whether it's a ELSS, equity, or debt, in a single demat account. We typically have a recommendation list, and it has 3 mutual funds per category, and we allow you to choose what you would like. Even in the direct equity portfolios, there's no hard and fast rule. We have like a list of 13, 14 stocks currently, but not all our clients would be investing in all those stocks. Some clients would choose to basically pick and choose maybe 5 or 6 if they are comfortable with further concentration. I'll be covering a little bit about the markets now. Again, Buffett says, in the business world, the rearview mirror is always clearer than the windshield. So I think we look back at these times and also say, that this was the time to invest. Just want to take you through my thinking on this. I'm sure many of you have seen these slides, similar ones before, but essentially, what are our financial savings options? They're essentially fixed deposits, debt mutual fund, or equity. So I compare these 3 here. Equity basically can help you grow your money faster than inflation. So if you look at these, CAGR is basically compounded annual growth rate returns, right? So in a FD, what we did again here was take 100 rupees invested as of 1st Jan 1999, and how that would grow, over the next 21 years. So in a FD, your money would go to 425 as of Jan 2020. And as of March 20, despite the fluctuation and the pandemic, your money would still continue growing. So that's because, the FD is a assured return, and the money continues to grow. And we'll see that the CAGR return there is 7.1% versus 6.4% is the inflation over the last 21 years, taken from the World Bank data. Debt mutual fund, on the other hand, goes from 100 rupees to 484. And in March 20 also, it continues to grow to 498. More like a flattish growth though, but still it continues to grow. And in the long run, it gives you a 7.8%, slightly better than FD return compared to inflation. Equities, equity again here, so throughout the presentation, when we mention general equity, we mention the Nifty 50, and the time periods we've taken are all the same. 1st Jan 1999, and 1st Jan 2020, and then 31st March 2020, to just show you that in equity the returns can be quite volatile. While you can see that it's almost more than double the return of debt mutual fund or FD, you reached a 1368 value in Jan 2020. But then you also have to see this dip, right? So CAGR return would be of 11.3% in this period, but you have to be ready for this drop as well. If we these are pre-tax returns, tax again plays an important role, and it gives a huge kicker to equity returns, whereas it's a big downer for inflation, for fixed deposit returns. So all of us know fixed deposits are fully taxable, other than the 1.5 lakhs or so that you are able to put tax free. Debt mutual funds have a inherent tax advantage. They allow you to index to inflation, and in the long term you only have to pay 20% tax rate after indexation. So you can see between the first slide, the 7.1% return of the FD has dropped to 5.4% post-tax. The 7.8% return of the debt mutual fund has fallen to 7.4%. And equity 11.3% return has fallen to only 10.8%, and that's because the long-term capital gains tax actually only came in 2018. So until then, all your long-term capital gains were tax-free, and which is what essentially we've assumed. And so tax incentives are a big reason why people should be investing in equities, other than the obvious wealth building over time. So if you go to see, fixed deposits, you're actually losing purchasing power in the long run. So because you're only earning 5.4% versus inflation is at 6.4%. What do I mean by losing purchasing power? What I mean is, like, if you are saving today to buy something, in the future, and that the price of that inflates at 6%, but your investments only grow at 5%. So then in the long run, you may not be able to actually afford what you were saving up for in the first place. So you have to actually invest even more and more than, what you may have originally put in to invest finally. Whereas in equity, again, fluctuations aside, long term, you can create money if you do it the right way. Making the same point here about, equity markets are non-linear. So again, we've taken that 100 rupees and shown you how it grows. And I would say, equities are a spicy dish, which you should have only if you have the stomach for it. So not everyone has the capacity to stomach a spicy dish. So similarly, equities is not meant for everyone. And a simple example here, 100 rupees invested 1st Jan 1999. Initially, if you see in these first 3 years, your money actually, sank between 2000 to 2002, 2003, and it only recovered after 2004. So had you invested 100 rupees here in equity and you were expecting like a gain in 3 years, 4 years, you probably lost money. You were better off putting it in FD and debt MF. But for people with a long-term horizon, 5 years plus, 10 years plus, equities is a great compounder and wealth builder over time, keeping these zigzags in mind. So what is the best time to invest? I think this right now is a great time to invest, and this chart essentially is trying to show us, why. This is the Nifty moving again between the last 21 years. And you can see in Jan 2009, there was like a 51% drop in the index value, between 6138 to 2763. But if you look at the blue section is essentially mutual fund AUM, which is the mutual fund industry in India. And if you see, the mutual fund industry actually moves alongside the Nifty. So when the Nifty drops, obviously AUM invested would also drop, but unfortunately we see that retail investors actually pull out money in bad markets, whereas they should be putting in more money here. So, it's the advisors, people like us, our job to tell people that this is the time to invest, and, not to pull out your money out of fear and, anxiety. If you have a long-term enough horizon, things will bounce back, and you can see what a sharp bounce back there is, and then the markets make it to new highs. Again in Feb 2016, sorry, if I can request everyone to mute yourself, please. Feb 2016, again, there was a drop of nearly 21%. You can see that, but then bounced back up. And now the current situation, right? March 2020, we dropped 38% actually. And now we're back up. We're down 20% from this peak currently. So if you think you've missed the bottom and you don't invest, we're still 20% below the highest mark. So why not now? Sorry, I'm having some trouble switching. Just hang on. Yeah, okay. So, some of us who've learned economics learn that, okay, with higher returns comes higher risk. That's true for equities. And if we were discussing that we made about 11.5% on the Nifty, you can make much more if you actually invest in individual stocks. And here's how. So this is just an example of 10 companies, large cap companies. Several of these names would be quite familiar to you. These are 3 in banking, 2 in pharma, 2 in IT, and 3 in consumer space. If we just take the example that we put 10 lakhs to work, as of Jan 1999, then that 10 lakhs by December 2019, in 20 years with dividends would be worth 64 crores in HDFC Bank. ICICI Bank would be 17 crores. State Bank of India would be 5.6 crores. So you can see the outcome is quite varying, but the winners here seem to be HDFC Bank, 64 crores, and Lupin, 67 crores, even Infosys, 62 crores. So that's actually a 640 times your money, over 600 times your money in 20 years. That's a huge compounding power, right? But like I mentioned, the 3 banking stocks, if you look at, their multiplication is very different. HDFC Bank would have been 600 plus, ICICI 171 times, State Bank of India only 50 times. Even though 50 times is not a small number, but you can see the performance is very different across all 3 banks. And here is where Opportune Wealth and other mutual fund managers and other fund managers come in, right? They try and help you find the winner in a particular sector. And, HDFC Bank, I'd like to disclose, obviously, it's part of our portfolio. And it's one of the oldest companies in our portfolio. It's the first stock we bought. Literally 2nd September is when we started, and 9th September is when we bought the stock, and it continues to remain in our portfolio with hardly any change. And yeah, so if you were to supposing do this on your own, you would either pick one of these 3. You may pick the wrong one. You may allocate money, say 100 rupees, to a different in proportion. So then your performance would be somewhere between 50 and 640. But if you would go with a portfolio manager who has the confidence, then you would pick the 640 and put all your 100 rupees in 640. And so, that's what we are trying to do here. Again, to make it clear that things again are volatile. These 640 was as of December 2019. If you see the returns as of 31st March 2020, that number drops to 450. So that's the kind of, stomach of steel I'm expecting people to have when they enter equities, that it's not a rosy ride or a walk in the garden. One has to be willing to stomach this kind of dip. And while, like I mentioned, for retired clients, we have taken cash calls in the past, because at that stage in your life, you can't kind of see your portfolio drop by 20 and 30% and still remain calm. So we do some customizations depending on the client, but these are inherent equity portfolio risks that everyone should be willing to bear when they come in. So one more topic I'll cover is basically, how do you diversify versus concentrate in a portfolio? Like what we just discussed about the banking space, these three banks, and how would you decide how much money to put in each, and how would you decide how much and what to have? So how do different portfolio managers essentially do it? So take the example of mutual funds, right? So any of the mutual funds, they basically try and pick up anywhere between 70 to 80 or 100 stocks out of the many stocks that are available, essentially like a funnel. There are thousands and thousands of stocks available out there. Mutual fund companies have research analysts, they have fund managers who decide some criteria basis which they decide to invest in 70 to 80 stocks. The benchmark, of course, is the BSE Sensex, which has 30 companies, and Nifty 50, which has 50 companies. Now, these are not really selected by anyone. These are self-selected in the sense that these are the largest 30 and 50 companies that are listed on the stock exchange. And where do we come in? We are essentially trying to funnel, the most investable ideas. I'm not saying we copy mutual funds, but essentially a lot of our names are well-known names, but we are trying to pick the best 10-15 stocks from mutual fund portfolios or from the Nifty, or sometimes even smaller companies, because like I mentioned, we have a multi-cap portfolio. So ours is quite a concentrated portfolio compared to mutual funds, which will give you a wider basket. One of the most popular mutual funds these days is the HDFC Top 100. So that itself means it's the top 100 companies, by market cap, and they're giving you like a vast variety of diversification across sectors, companies, but they're picking the largest, like 100. So wanted to cover our research methodology. Basically, how do we go about this funneling approach? We do this by a 4-pronged approach. Essentially, we look at select industries. Within select industries, we try to find a winning company. Once we found a winning company, we look at their management. So the management should be taking decisions which are good for shareholders versus those that are bad. And then lastly, we look at valuations. So I'll be covering the industry and company part here in a little bit of detail, just to give you a flavor. And management and valuations, I would say, is more of a judgment call. So moving on to the industries. So industries that we like, typically, you saw in the first slide that I had an allocation of what we are holding currently. So we typically like, asset-light companies, which have strong cash flows and high growth. So currently we have exposure to banking, FMCG, which are fast-moving consumer goods, pharma and healthcare, technology and IT. These all, in our opinion, are high growth, asset light, strong cash flows. And those are the kind of industries we try to get access to. The ones we tend to avoid are asset heavy industries, which require large capex, and they are typically low growth. So which in our mind fall into these are oil and gas, cement, and power. So just to give you an example of the oil and gas industry, essentially the price also of oil and gas is not really decided by the manufacturers. The price is decided by the government, despite everyone knowing that oil prices globally at a trading level have fallen to below zero and recovered, and they're at $10 and $20. You see no change in the price of petrol in your local petrol pump. So it's pretty much managed by the government. So in our mind, it's pretty clear. If you can't predict something, if you can't predict the price of oil 2 years out, and nor can you decide your own price of your product that you're selling, then it's not an area that we would like to be investing in. So company analysis, once we've selected the industry, we look at which company we would like to be invested in. So companies essentially have moats, just like a castle has a moat. I'll explain that analogy a little bit. Essentially, this is like a old medieval castle which has a moat around it. Moat is like a water body which has crocodiles, piranhas, so that any enemies wanting to come and enter and take the treasure from inside the castle are prevented from doing so. And so if we imagine that the castle is just like a company, and inside, instead of treasure, they have profits, and their enemies are basically other competitors, new entrants, or existing competitors in the industry, who try and copy the company or try and come in and take the profits. So there are certain things that companies do which essentially prevent competitors from entering. So this is both a qualitative as well as a quantitative aspect to analyzing moats. And the quantitative way to do it is basically seeing that return on capital employed is greater than cost of capital for over 10 years at minimum. So there are ways to predict this even in say technology companies, which is again what my research team and I do. Just to give you a little bit of an insight what we look for in a company. So sources of moats are basically brands and patents. So brands like Asian Paints, right? So Asian Paints would be able to charge a higher price for their paints versus say another local player. Sanofi has many patents which allow it to manufacture and sell drugs again at higher price. So brands and patents give people pricing power. Another moat source is low cost per unit. So both DMart and Walmart have such high volumes which they are able to get suppliers to pay them, sell them items at very much lower than market cost. So that is an inherent advantage. Sticky customer habits is another. Here mainly it's for B2B players. So Microsoft, Oracle, these are all B2B selling companies, which essentially if a company has Microsoft computers, then it's very unlikely that over a decade, 2 decades, they will actually move to say Apple computers, because there's a learning cost to it. They'll have to teach everyone in their office how to use the new system. So these habits are sort of like sticky. Another one is more buyers, more sellers. So these are typical for marketplaces. So Amazon would also fall in this, Facebook, Naukri. These are some examples. Supply greater than demand. So this is where an example of GAIL. GAIL is the gas pipeline in India. So here when the supply of in a particular industry is greater than the total demand, which there is, it only makes sense for one player to actually be, giving all the supply. And if anyone more enters, then it basically means that there's irrational competition. I would want to put telecom also here. But I guess customers switch and everything like that. But essentially, supply greater than demand would mean irrational competition for people to enter. So that's a quick summary. What we've covered is industry and company. I'll just quickly say a quote each on management and valuations. So when we say sound management, right, this is just a comic strip, Dilbert. I'll just read it out in case someone can't read the fine print. So one of them says, you should be proud that we beat the earnings that analysts expected. Dilbert's like, why should we be proud that analysts are bad at making estimates? Management says, those bad estimates don't happen on their own. I had to mislead them. And his boss says, I'm proud of you. So essentially, listening to con calls on a consistent basis of all management gives us a sense of whether management is honest, integrity, are they doing things with the right mindset. And I'll also speak about my past working background, which kind of helps me deduce this a little better from my strategic consulting days. On the valuations front, I guess all we can say is that the stock market is a device for transferring money from the impatient to the patient. So while we do look at PE multiples of a company when we buy and when we sell, but essentially over the long run, what we are expecting is PE multiple contraction. So whenever we buy a stock, we never assume people are willing to pay 20x today, so they'll pay 30x tomorrow. So we never expect that, oh, someone will pay more for what it's worth today. We always expect that the value of the business should grow, and that will in turn lead to the company being valued better. I hope that makes sense to at least the ones who've been in the markets for some time. So that's a summary basically of the research methodology. Just covering, quickly about us. So Opportune Wealth Advisors was set up in 2016. What we have is a equity advisory and mutual fund advisory. We are a SEBI registered investment advisor and an AMFI certified mutual fund distributor. And that's how we do both of what we do. A little bit about myself. So my first 4 years of working were at Monitor Group as a strategic consultant, where I covered a vast number of industries, some of which we have exposure to, some of which we'll never touch. So oil and gas was one of the industries where I had some consulting work. FMCG was other, some in agri and automotive. I think like a lot of different industries that I had covered in my Monitor Group time, which really helped me still distill which companies are good and which industries are good. After my stint at Monitor Group, I wanted to shift into finance, which is what took me to Chicago booth. And there I did a MBA in finance, accounting and entrepreneurship with an idea that I would want to start a company in the future. Like I mentioned, I met Warren Buffett just 3 months before I graduated from Chicago booth. And I actually had a venture capital job waiting for me back in India after graduation. But once I graduated, I decided I don't want to take up that venture capital job. And instead, I was looking for an equity research job because I changed my decision on what I wanted to be in. Vikram, I think you've just joined now. Can you put it on mute, please? If everyone can just put yourself on mute, please. So, yeah, after Chicago booth, I joined Morningstar in December 2011. And in the 4 years at Morningstar, I was covering pharma, consumer, and banking. Those were the 3 sectors I was covering, and about 13, 14 companies. And alongside, I was also managing my own portfolio. So at Morningstar, I got about 70% of all my calls right, which gave me the confidence to, quit that job. And alongside also, I was managing my own portfolio with more than doubled in the 4 years and more than beat the index. So in 2016, I quit Morningstar and I started Opportune Wealth, which is why, we're all here today. A quick look at, my current team. I introduced you to them at the beginning. So in the operations side, we have like 2 departments, advisory and MF. So while everyone looks at everything, we basically have, both the departments segregated. Pyali is a part of the advisory team and looks at client relations as well. And Anuja looks at operations and is part of the mutual fund team. On the research side, it's Shivam and Aditya, and I am basically overseeing all 4 of them. We have a cabin in the office in Kolaba. Basically, it's a co-working place. It's called Bootstart, and it's a 10-minute walk from my house and quite far away from everyone else, as most of them live in the suburbs. But yeah, we haven't been to office in 2 months, but we continue to work virtually. We actually just completed 2 years of being at this location. So once office reopens, happy to have you guys come to our office anytime. Just wanted to cover this since I get a lot of questions towards the end about how to become a client and the sign up process. Just a quick walkthrough. We essentially do a risk profiling form to see whether equities will be the right fit for you. And if we find that that isn't the case, then we might even discourage you from taking the equity portfolio. We have a client agreement in place, which essentially talks about our fee structure and how we've segregated the mutual fund versus the equity portfolios. Then, like any SEBI intermediary, we'd have a KYC process, and then we'd open a dedicated personal demat account in your name. and then Opportune Wealth would basically advise you on that demat account. We prefer a separate account only because our fee is linked to how our portfolio performs, and so we like to monitor it. And we have a tie-up with Motilal Oswal to offer us very low broking rates. Since we don't share any part of the brokerage with them, they've given all our clients very reduced brokerage charges. In fact, I have some people who are now opening the accounts through me, so that traders who are opening the account through me so that they can just get those low broking charges, even though they're not under our advisory. So once your account opens, what we do is we do a portfolio allocation as per our model portfolio. On an ongoing basis, we do the monitoring of your portfolio, and in case we think something is not performing well, we would take out a particular stock or add something in, and this would happen across clients. Unless we don't have a POA on your account, so you would always have the choice to choose to go ahead with that transaction or not. We send out quarterly reports on your portfolio, and on a quarterly basis, we charge the 2.5% per annum is a yearly advisory fee, and that's not on the mutual funds. It's only on the equity portfolios. On the mutual funds, we just make a distribution fee through Motilal Oswal, so we don't charge you any advisory fee on that. But we basically split that up per quarter. Just a quick look at the disclaimers. All of the stocks that I mentioned, we do have exposure to some of those, and please of course decide on your own. And we also don't have a POA, so all clients have the option and should make their independent decisions while making the final call.